Are you or your investment advisor your worst enemy when it comes to investing success? Well, what we find from the research, Dalbar is a company that does this research on investor behavior, is that is exactly the case. The first time that I saw this research was in the late 90s. And they were looking at do-it-yourself investors versus an investment advisor working with an investor. And what they found is that they actually had very similar returns. They were both bad. And what they found was this, that investors typically suffer from this. When markets go up, they get excited. They feel great about things and they want to buy. They want to put money in the market. Then when markets go down, they tend to get scared and they tend to sell. It's just the opposite of what we want to do. And instead of, buy low, sell high, they tend to buy high and sell low. Well, what Dalbar does is about this time of year, they come out with the new research and the new estimates. Now, let me explain what they found this year. If we look at the market, we know that we have small companies, we got large companies, we got growth companies and value companies. I've taught that before. And they typically just look at the average equity investor. So all different markets, we'd have different expected returns in these different markets historically. Large US stocks, about 10, about 11 there, about 12 there, and about 14 there, right? So what they do is just in general look at equity investors. What they found is that on their 30-year data, that the average investor, stock investor, had a rate of return of about 8%, less than any of those asset categories. Now, just to put that in perspective for you, let's say we had 30 years and we took $10,000 and we invested that $10,000. What would it have grown to? Well, at 8%, it grew to about $100,000. Yeah, thereabouts, pretty close to that. Now, what happens if you get a rate of return of, well, let's just put 10% in the calculator and see what it comes out to? Well, it's about $174,000. So you can see just a couple percent difference makes a huge difference in return historically. But one of the things I like to point out here is this, and I saw the data and I said, I've got to explain this to people. When you hear me talk about taking an income from your portfolio, you'll often hear me talk about the 4% rule. What level of income can you take out of a portfolio that's diversified between, let's just take 3 asset categories: stocks, bonds, and cash? What kind of income can you take and increase it for inflation each year? Well, the answer, about 4%. So if you got $1 million, you can take about $40,000 out first year and increase it every year for inflation. Well, what they did in the research is they looked at the average asset allocation investor, somebody dividing their portfolio in this manner, and what was the return that they estimated that investors are getting? Well, the answer was not so great. 2.95% return. 2.9, that's less than the 4%. So when you hear that the industry is walking away from the 4% rule, quite often you hear that and go, well, I can see why. They're not getting the results that the study showed. But why aren't they getting the results? Well, I've talked about this before. It gets down to not following the rules of investing. They engage in stock picking, market timing, trying to figure out where the markets are going to go next. They tend to buy when they get excited or increase equity holdings in portfolios, and they tend to decrease equity holdings when they feel a little bit nervous. They're doing the opposite of what we really need to do to be a successful investor. So when this research comes out, I like to pay attention because this shows us what's going on in the industry and why it is so important for you to be an educated investor.